time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price if they have extrinsic value. Now the prices of the options, these are called in-the-money options. The in-the-money options have some component of what they call extrinsic value and some component of intrinsic value. And the way you can determine intrinsic and extrinsic value is simply by taking the strike price of the option. In this case, we're taking a look at the May 20 calls, and they're priced at $7.40. On these 20 calls, if you add the strike price to the price of the call, you get $27.40. At the mid price, you're probably talking about closer to $27.25 or $7.25 for the price of this call option, which is exactly the price of a current stock. So you could say that this call option has no intrinsic value. In fact, if we look under extrinsic value, you can see that it is actually zero. The closer you get to the at the money or the actual price, strike price of the stock, you can see that there is in fact some extrinsic value left. There is some time value left in that option, and that time value is basically saying that, hey, you know what? We do have 3 or 4 weeks before expiration, so the price of the option may actually increase to the point where it might be actually further in the money. What is our objective, though? Okay, this is just a very brief. You should have already a basic understanding of options. I probably haven't told you anything new, or maybe I have, I don't know. But depending on your experience. The important thing to remember, though, is that when we trade for monthly income, what we hope to do is not only sell options, we are going to sell both sides. We're going to sell calls and we're going to sell puts. The reason for that is because the stock cannot be in two places at one time. In other words, if you sell this 27.50 and you sell these 25s, well, it can't be both at 25 and 27.50 at expiration. We're going to make money on one side or the other. And that's an important distinction to make because we make money whether the stock goes up or down. Now, the types of vehicles that we use in order to trade options on the exchanges are normally going to be, and I'll go through all those with you in the next series here in portfolio building. What we're going to be using are normally what are called calendar spreads and the sale of vertical spreads, specifically double calendar spreads and the sale of iron condors. Those two strategies will comprise most of our system and most of the trades for the month so that we can make a monthly income and generate a monthly income. Let me just show you the trades that we currently have on so you can kind of get a picture of what I'm talking about. These are trades that we just put on recently. We have 4 positions. We have a iron condor, sale of an iron condor in the diamonds, which is a ETF that mimics the Dow Jones Industrial Average. We have a double calendar rather on the EEM, which is the Emerging Markets ETF. We have a double calendar position on the IWM, which is the Russell 2000 Index, ETF for the Russell 2000 Index. And we have the sale of an iron condor on the SPY, which is a ETF on the S&P 500. These positions, normally when you put them on, all show a loss at the open. However, there's a couple things that you really need to take a look at. Number one, this white line here is what our current profit and loss position is. You can see that the current price, the live price of our portfolio based on the S&P 500, or on the SPY rather, ETF is right here. And in fact, it is in the center between our break-even points. Our break-even point on the low end is down here around 133, And our break-even point on the upper end of the price chart is 143.65, someplace around there. And we are directly, almost in the center of that. Since we just put this position on, we are in a position of a slight loss in our position. However, what we need to take a look at is what happens, as I told you, to a person who purchases an option. Now we are selling them that option. We are the seller. And there's two rules of the market as far as options go. Number one, they will fluctuate in price. And number two, they will always expire. And we take advantage of both of those absolute rules of the option market. And that's what makes this strategy so powerful. Number one, it fluctuates in price. Well, as you can see, we have lots of room to move.